Hello, everyone, and welcome to Core Training. And this is the Core Training analysis portion for pivot-based analysis. And this is one of my favorite topics. As you all know, I'm the author of the book Secrets of a Pivot Boss. And in that book, I talk about pivot-based relationships. And specifically, I also talk about how when I first discovered pivots, I really felt like I had reached another level in my trading. Like I had discovered some form of hidden areas of support and resistance that were only the secretive type of traders knew about. And of course, floor pivots have been around for a while. Even Larry Williams documented it in his book back in 1979. So they had been around for a while. But there's different types of pivots as well, from the Camarilla pivots to market profile based pivots. To the pivot range. And all of these have evolved over time, and there's different mathematical formulas and different equations for them. But we're not going to get too involved with how they're all super calculated. Obviously, we have a stat sheet here that shows you the calculations. But what I really want to do is help teach you how to use these tools to forecast certain market behaviors. And that's very important. Again, that's a revolving theme in this core training that we've seen this entire time, which is the ability to use the tools to not only understand what's going on, but to be able to use the tools to forecast future price behavior and direction. And that's what's so powerful about pivot-based pivots. These form of pivots here really help you identify and forecast scenarios where you have very high odds of a breakout in trending market, or you have high odds of a structured markup phase, or you have high odds that you're going to see a trading range market. There's just certain conditions where you just really have high odds for measuring these things quantifiably. So that's what's so powerful about these pivots, because they give you an ability to not only forecast future price direction, but also behavior. And that means that you can then anticipate the type of market that you're going to be engaging, and you can then deploy the proper bidding strategies. For example, if you forecast that the market's going to be a trading range market, you can look to then become a responsive participant looking to fade the extremes back to value. If you're looking for the upcoming market to be a trending market, then we'd be looking to be a participant that is controlling the trend and defending any counter trend rotation. So that's what this training is about, is the ability to use the tools to forecast what's going to happen in the upcoming period of time, and that gives you advance notice on what's going to happen so you can prepare for those scenarios. So every trader, at least in my opinion, should have a solid understanding of pivot-based analysis, as this form of analysis has many advantages, including being universally applicable to all markets and time frames. And this is one very important quick sheet right here, because an entire course can be made just on this right here, because these are very important bullet points, and I'm calling them the 7 reasons every trader should use pivot-based analysis. And again, this goes back to when I was first trading. I was primarily looking at chart patterns and candlestick patterns for the most part. But once you introduce pivot-based analysis into your trading, there then becomes a way to scale all of that information to all different types of time frames and platforms, and the ability to then code that into computers and algorithms, and then have them run it on so much data. It really opens up so many doors. It opens up so many doors. And so this is a really detailed way of looking at how to approach any market using a tool that I call like a Swiss Army knife. Pivot-based analysis is like the Swiss Army knife of technical analysis. It can do so many things in so many different ways, and actually do them all very well. And so some of the great reasons here that you should be paying attention to pivot-based analysis, if this is your first introduction, is number one, it's market-generated information. These pivots are based off of market-generated data, like the open, high, low, close, for example, or the volume. And when you have indicators or pivots that are based off of market-generated information, you tend to see greater market participation at those levels. That means when these levels are based off of real market information and not some sort of derivative information, then you're actually going to see more participation by those buyers and sellers at those levels. So really it becomes kind of like a self-fulfilling prophecy. Number two, leading and predictive. That is a huge reason that I really discovered and wanted to discover a tool like Pivots, because I didn't want to know a tool that gave me hindsight in terms of telling me where I should have been in or out. I wanted to know ahead of time. Not only did I want to know ahead of time by a couple of minutes or a couple of seconds, I wanted to know the day before or perhaps the week before that something was going to happen. And that's what pivot-based analysis allows you to do. It is predictive because they are pivots that are based off of equations and formulas that you can know what those pivots are before the next day comes up. So as soon as the market closes, you can have those levels calculated and you already know what the upcoming session's levels are going to be. That's leading predictive information because you already know if there's some sort of characteristic that implies that expansion is going to happen, or you already know that maybe value is advancing, so we should be looking to defend pullbacks in that price discovery phase. So when you have leading predictive tools, it helps you prepare for and plan for the upcoming period of time. Number three, self-adjustive volatility. This one is very, very important and one that I think it goes overlooked sometimes because every market, the personality markets theory, remember, states that the markets go through different phases over time, different personality types, from a wide-ranging trading range one personality type to then going to a price discovery phase, another type, to then having a very tightly coiled congestion price phase. So all these various phases come with it different volatility types. So following volatility, however you follow it, is very, very important. Understanding that the volatility has dropped significantly over the last few days compared to what it was 2 weeks ago tells you that you need to be able to adjust the way that you approach a trade, whether it's entering or the trade management aspect. Because if the NQ had been rallying and selling off in 100-point bursts during one period of time, that doesn't mean it's always going to pay off at 100 points per pop, because in the next coming period of time, you might only see 10-point rotations. So you have to be able to adjust to the current volatility. And inherently speaking, pivot-based analysis just auto-adjusts because it's using market-generated information, and that's why they're so powerful. Scalability, this one is huge, and this one I think goes hand in hand with the algo advantage as well. These pivots, any kind of pivots that you're looking at, are scalable to all time frames or any subsets of data that you define. So if you want to look at day-over-day pivots, then that whatever information you input into that equation, you're going to receive back the proper levels for that data set. If you want to look at 2-day versus 2-day relationships, then it's going to work out. If you want to look at week over week, month over month, however you define it, you're going to be able to scale these. And as you know, and we'll see, especially with regards to Pivot Boss pivots, not only are we able to create pivots that are based off of the previous session to create pivots for the upcoming session, or the previous week to create the upcoming week, or the previous month to create the upcoming month, but the new wave of pivots, especially like the ones I created for Pivot Boss pivots, allows you to create pivots for any user-defined aggregate period of time. So you can create hourly pivots if you want to, 2-hour pivots. You can create pivots based off of a 4-hour period of time if you want to, or whatever user-defined period of time. And every single period of time you'll find has algorithms that are already engaging those time frames using those pivot-based rules. So that's why it makes it really cool, because this type of idea, these types of tools are scalable, and they have the ability to be automated, really, and that opens up so many doors. Number 5 here is revealing confluence. And so whether it be multiple time frame confluence or multiple pivot confluence, the ability to reveal these hidden areas of support and resistance provides a huge edge. And that's one point that I think really resonated with a lot of folks that read my book, Secrets of a Pivot Boss, is that toward the latter chapters, there's a chapter called Higher Time Frame Confluence, or Higher Time Frame Key Levels, that type of title. I need to go back through the chapter list and look. But it's a multiple time frame confluence chapter where we're looking for multiple time frame hot zones. And that's where you're seeing pivots. Not only if you're using just floor pivots, for example, you can create daily pivots and then overlay the weekly pivots. And now you have a confluence zone that you can look for. But you can also do multiple pivot confluence, which has pivots from a Camarilla equation, also pivots from market profile confirming with maybe perhaps pivot boss pivots, and then you have a very kind of a lot of depth around the confluence around those levels, because now you can have multiple tool confluence and you can have multiple time frame confluence. So anyways, when you have that much ability to do those types of confluences, while it's difficult for humans to process that all that information at once, the computers can do it automatically. And again, that's about the time when I was able to basically automate the pivots and get them onto my screen and run it on a large set of data, is really when all of these various concepts that we're going to be talking about with regards to pivot-based analysis, they all came to life and jumped right off the screen at me. And that was over 10 years ago. Okay, so the algo advantage. Pivots lend themselves perfectly for creating mechanical or fully automated algorithms to find and execute trading opportunities. And that, again, is very important, because when you're able to then, scan large amounts of data and bring back those certain opportunities, those certain points in time where there's a high tendency that you're going to see a certain outcome, you can bring all of those various events right to the forefront of your screen. And because it's all based on math, all of this is just equations and formulas, because before it was a lot of chart patterns and those types of things, and now it's a lot more math. And so being on the cutting edge of platform development as we were, and then creating cutting edge tools for clients as we were, I was able to not only be a part of bringing platforms to traders that had a lot of great tools built in, but also part of the movement of bringing some of these tools and automating them for algorithms. And so I got some great stories about that as well, because some traders got very angry with me for releasing certain formulas, like, I was releasing a big secret or something. So, that's how heated it gets around some of these levels, because there is competition around these levels. But I think that's all a self-fulfilling edge that we all have, because if there are more machines watching those levels, there will be more participation. But not every rotation off of one of these levels is going to be perfect. And so that's why it's up to us to understand when the best times to trade those outcomes are, or those potential opportunities. And lastly here, number 7, universally applicable. This pivot-based analysis can be applied universally to any market and any time frame, regardless of your trading style. And again, I did that by design. I wanted to be able to use an approach that allowed me to trade on an intraday basis, the same I would trade on a swing basis, or the same I would trade on a position basis in terms of analysis and those types of things. Execution, obviously, you can execute so many different ways, all the way up and down the scale. But in terms of analysis, I wanted analysis that allowed me to universally apply certain concepts, the concepts that help me identify compression and expansion. Remember, those are the foundational market concepts that we learned in our theory portion of core training, which is compression leads to expansion. Compression is a trading range phase, leads to a price discovery phase. And expansion leads to compression. So a trending phase leads to a trading range phase. Each one of those markets and each one of those auctions has its own way of bidding in those auctions. So we have to be able to identify and forecast when they're coming. And that's what these tools allow you to do. So there's so many great advantages to using pivot-based analysis. And that's why I'm really a great proponent for them. But you have to know how to use them properly. So Pivot Boss Masters teaches a core group of pivot-based indicators, which includes pivots that are based on classic formulas and some with newer equations. Some are secretive and some are data-driven, not to mention our very own Pivot Boss pivots. Each of these tools abides by the laws that govern pivot-based analysis. Not only is it a universal approach that you can use to any instrument or time frame, but among pivot-based indicators, you can use them all the same. So that's why I really gravitated. Once I was able to really understand the floor pivots, and then add to that the pivot range, I was then able to assimilate that same pivot-based analysis philosophy or approach and assimilate it to all the other various pivot types. And that's really, really important. So, you learn something for the first time, you start to understand things about that thing, whatever it may be, in this case, pivots. And then once you get a good control of that and you say, what are these Camarilla pivots? And then you start to see the patterns emerge, then you start to connect the dots, and then you start to use them together, and then you bring in some market profile, and you understand those levels, and then you start to see the confluence that each of these tools can bring. I mean, it really helps you understand how these levels can be super powerful because of all the multiple time frame ability to create confluence levels at all those various time frames and all the various confluence levels among and between themselves. It's just a really cool group of indicators. Now, in floor pivots, many of you are familiar with floor pivots. Again, Larry Williams wrote about floor pivots in his book back in 1979, and I think it was How I Made $1 Million Trading Futures. And basically, he talked about this pivot-based formula where if the market was trending higher, he would take the formula, and then he would find what that first support was and that first resistance. And the idea was you look for the pullback to the higher support to buy it, and then you hand it off at the higher resistance. Because if you're in a trending up market, then you're looking to buy the dips and sell the rips. So basically, it was a crude version that he said, you know what, if the market's been trending up, then I run this pivot formula that gives me a support level and a resistance level. And when price comes back here, I'm looking to buy it and hand it off here. And, when you go back and actually read the text, which I have, he set the stage for pivot trend analysis. He didn't mention the trend analysis. He didn't mention any of that. He just said, if price has been going up, then I want to buy right there and sell it up here, That set the tone for pivot trend analysis. And now in the ability to use these computers or use these platforms to plot all of these various levels, because at the time, all you had to do was get a calculator out, and then you had to hand put these levels on your screen, But now we can click one button, and we have all the levels pop up for the last X amount of days or the X amount of years. And when that happens, that ease of plotting everything, all of these relationships start to emerge. And so that's why you have to be grateful to be able to trade with this type of analytical software. But this is kind of the evolution of my understanding in terms of all of this right here. I learned these first, floor pivots, and we'll talk more about them in a second. Then I threw on the pivot range, and from there, Camarilla, market profile, and then Pivot Boss pivots. What's great about Pivot Boss pivots, and we'll talk about that when we get to the proprietary training portion, but what's great about Pivot Boss pivots is that I created those after having experienced all the other various pivots. And so I understood how this one worked. I understood this one and this one and this one. And so having understood all of those, I came to a determination that, the best way to approach it is probably in this manner. And that's the way that I started approaching it instead of all of these ways. And I still use these other ways if I need to, but this one as well, again, because this is pivot-based analysis, you're able to use every single one of these concepts on every one of these tools. So they're all interchangeable, which is fantastic. So this is a great group of pivot-based indicators here, and we'll talk more about them in a moment. An array of analytical approaches. Now, this is always huge, and many of you have heard me use that phrase before, because there's so many different ways to use these tools. And they're very simple ways as well, very visual ways. Pivot width analysis, pivot trend analysis, and value relationships. And basically, it's just using the value area in many of these cases, or whatever given value area that you're trading with, in order to measure the width of a certain value area or the distance from value areas before it or following it. And basically that allows you to identify certain situations where prices are going to be trending, price discovery, that type of thing, or where the prices are going to be range-bound, bracketed, trading range markets. And we're going to talk more about these right now. So here's the core group of pivot-based indicators. And again, this core group includes the pivot range, floor pivots, Camarilla pivots, and market profile levels, which offer well-rounded tools for pivot-based analysis. And so I made mention in the previous slide that some of these are, classic indicators. Some are data-driven. Some are kind of the newfound equations and those types of things. Some are secretive, right? So that's why I said there's a good core mix of these types of indicators. For example, I know not everyone is well versed in pivots, so we'll just spend a couple of minutes here on each one of these. Number one, floor pivots right here, as I mentioned, made famous by Larry Williams there, and he talked about it in his book, and from there it got picked up a little bit more, and everybody started using some form of pivots like this. Now, when I received the equation or the formula, it was up to, I think the standard one is only up to R2 and S2, perhaps, maybe even R3. But in our labs, I created it out to R4 and S4 and all the way out. So I actually included it all the way out because of one key factor. When I went back over decades of data, the market's volatility was so much smaller back then that it only did trade between these first R1 and R2 bands. But as time came on, especially through the 90s, you saw more explosion out to the beyond those levels, in which case you needed the bigger outside levels. So in our labs, I said, you know what, I'm going to include these, and I'm going to call it the expanded targets or the advanced floor pivots. And additionally, I added the pivot range to it. So the pivot range was something I added to the floor pivots. So traditionally speaking, floor pivots do not include this level or this level, and may or may not include these levels up here. So traditional floor pivots may only be a pivot plus 2 above and 2 below. Maybe sometimes you might see one with 3. So really, I added a whole lot of dang pivots, and that's what we did because I said, you know what, I see value and I see that the volatility is increasing, and why not? If price is continuing higher, why not be able to extend them outward? So that's what we did. I asked the developers to put it in there. They did in that way. And that's originally when I put this pivot range to be magenta or pink. And then I've stuck that way ever since. It's been, I don't know, 12 years perhaps. So we've had them on the board for a long time. And so I've done a lot of great back and forth testing with all these over time, and they always came out very favorable, but you had to qualify when you trade these levels. So we'll be looking at some of this in Thinkorswim in a little bit. We also have the pivot range. This one right here was made famous in The Logical Trader by Mark Fisher, the book The Logical Trader by Mark Fisher, and he talks about his ACD method and how he uses the pivot range, and he actually, for the most part, only plots the top and bottom. And I like to plot the middle pivot as well to create a 3 pivot range. And so again, you can use it by itself or you can use it in combination with a set of pivots. I love to use it by itself, and I love to use it with pivots as well. So that's why I included it in the Pivot Boss pivots. Market profile levels. These are based off of the market profile TPO structure. So here's TPO. These are time price opportunities. Each one of these represents a segment of time. So for example, the first 30 minutes of a segment would be these A's. The second 30 minutes of segment would be these B's. The third segment would be these C's, right? And it builds out, builds out, builds out. So for those of you that aren't familiar with market profile, that's what it looks like, the TPOs. And from that, you get a value area, right? Very similar to volume profile value area. And you also get the point of control, which is the tallest peak closest to the center of the range. And that is your point of control. And so now you have the value area high, value area low, and the point of control that comes off of that. And for market profile pivots or more market profile levels, what we're looking for are the static VAH, VAL, and POC. And the static levels are the levels, the finishing levels from the previous session's range. So basically, it's if the market did this right here and finished with some pivots, the finishing profile showed this, then this is what you would project for the upcoming day. And then you would watch the market trade off of those levels. And then it would create more levels for the upcoming day based off of this day, right? So these are the static market profile levels. And lastly, we have the Camarilla pivots or Camarilla pivots. And these are the more secretive pivots. These are the ones where, I had an angry trader just getting very mad that I even released these pivots. Again, this is the Camarilla pivots where it was funny because a lot of traders in the mid-2000s had been talking about these secretive formulas, Camarilla pivots, and it's starting to hit pretty big. And then there was a website that started offering, hey, we have the real and only pivots, so if you want them, come get them. But there was a lot of versions floated out there. So what I did is I took all the various calculations and equations and I ran them through the data sets. And there was original ones, which I believe, for the most part, H4 to L4 are the originals. And then H5 can be different for different calculations. And I ended up settling on choosing this one as an H5 and this one as an L5. And it came out pretty decent. It came out pretty decent. So everything came out pretty nice the way it all set up. And the idea behind these Camarilla pivots is that they each have a different call to action. So this is almost like a self-contained trading system by itself. So for the most part, right here, that's H1, H2, H3, H4, H5. That's your resistance. And these are your support, right? And so these are color-coded bands. So L3 right here would be considered a green band, and L4 would be green. Meanwhile, H3 and H4 would be red. And so the idea is they're color-coded. So when price comes into green, you buy it and you sell in the red. So they're color-coded with calls to action. If price comes into the red, you sell it and bring it back to the green. If price pushes outside of H4, then it's likely headed to the H5 target, and that's the extension target, and that's usually blue, and the way I do it at least. So there's a self-contained trading system there, and we'll look at it again in Thinkorswim here. But for the most part, these are color-coded so that you have a certain call to action, and that makes things kind of easier for some traders, right? Because if you are trending up, then you should be looking to buy at the green pivots, and then sell at the red pivots. Sell at the red pivots, right? Sell at the red pivots. And that's what this is. And so it makes it very, very simple. So we'll look at a few examples of that as well. Let's see, that's a great question there, Tom. He's asking, Steenbarger has postulated calculating pivots using a 2x factor on the close. I know you've done a lot of detailed research in pivot generation. Have you ever found any viability to multipliers on the base pivot calculations? That's a great point there, and I have tried some of that before, and I always came back to the original calculation. And I have seen some older texts as well that want to include volatility things and open prices or some sort of factor to at least include some sort of volatility factor of some sort. But I've never seen anything that helped that cause, at least not from what I've seen. But I did try several times to make correlations or find edges, but that was never something I was able to really fully do. But I did love the idea. I just didn't think I was solving the challenge well enough at the time. So it's something that I would like to try again. Tim's asking about the Camarilla doesn't have a pivot point, just levels. That's correct. It doesn't have a pivot point, just levels. And really what's going on right here is that right here, basically you have your H's above and your L's below. These four right here, H2 to L2, are really what's called the hidden pivots. They're hidden usually. So they're so close to price, or so close around that edge that, usually you hide these areas right here and you only use H3, H4, H5, L3, L4, L5. So typically you're hiding everything in between. I wanted to show you all of the calculations here, but I also wanted to let you know that typically these are hidden, or there's an option to hide them. And should a market require that you pop these up, because sometimes there are markets where the volatility was really, really wide the previous session, so the pivots are going to be really, really wide today, and L3 might be way down here, H3 might be way up here. You're never going to get there. So you pop on the hidden pivots, and it gives you the lower volatility pivots to trade off of. And now you're looking to, again, defend in the L's and defend in the H's. All right, so pivot width and pivot trend analysis allow you to forecast upcoming price direction and behavior, at times with great accuracy, which allows you to anticipate and plan for upcoming opportunities. Pattern recognition is extremely important here. And that's, again, another running theme to a lot of this, is pattern recognition is very, very important. And what's great about pivot-based analysis is I believe that the pattern recognition involved for pivot-based analysis is very, very simple. I believe that anybody can do it, from your grandmother all the way down to your 2-year-old relative of some sort, whether it's your child or your grandkid or whatever. Even my 3-year-old can tell you exactly what's going on some of these, because it's just basic width measurements. Is it wide or is it narrow? Is it higher or is it lower? Is it inside or is it outside? It's wide, it's narrow, it's inside, it's higher, it's lower. And when those relationships occur, when you're dealing with value, and that's what it's really doing, it's dumbing down value for everyone. It's basically saying this is value, and value is now higher than last time, and that means a certain thing. Or this is value, and value is super wide, and that means a certain thing. So really, pivot-based analysis with regards to width analysis and trend analysis might as well be pivot shape analysis, almost like volume profile shape analysis, because you're doing the same type of relationships. And again, it all comes back to pattern recognition. So with regards to pivot width analysis, the ability to forecast with it is very important, because this form of analysis allows you to predict the likelihood of a market experiencing either a trading range or trending phase by using the width of the value area. So that's basically telling you that if you have a value area that's rather wide compared to average, then in the upcoming period of time, you're likely going to experience some sort of trading range. If the value area is very narrow, if it's very narrow for a given market, then that forecast calls for increased volatility and perhaps a trending or breakout phase. So if you have a value area that's very narrow compared to average, maybe average is something like this, then this tells you that the value area right here, the auction, has been very, very tightly bracketed, and at some point you're likely going to see compression lead to expansion, right? And so that's what pivot width analysis boils down to. Is the value area wide, or is it narrow? Or is it the same? Or is it outside, right? Or is it inside? Or is it higher or lower, right? That's all it's doing. And so when we're doing that here with this analysis, again, these are very basic concepts that help you forecast very powerful potential results. Inside value, I made no bones about it in my book, Secrets of a Pivot Boss. In the book, I said that inside value was without a doubt my favorite, absolute favorite setup to trade. And I believe I even start the book with it, an example of it, because that was when I finally was able to forecast, plan, and execute the trades that I wanted to trade. Because remember, this is what I told you at the very beginning of this entire thing. We're learning a lot of various techniques and concepts and tools that will help us do a lot of the same things. The main goal is to be able to identify and forecast trading range markets, and then forecast when we're about to see expansion from those markets, right? Because there's different trading and bidding up strategies in each of these markets. That's the basic idea. And so when you're able to forecast, hey, I think we're about to see a huge day in the upcoming day. And then you're able to plan and say, okay, I think it's about to happen. So this is how I'm going to enter if this happens. If this happens, I'm going to enter like this. And if this happens, I'm going to trail my management like this. Okay, so then I was able to plan with this inside value relationship, because that occurs when you have value and then you form value inside that previous value, and it's narrow. When you have that, that tells you that value is compressing, and at some point you're going to see expansion and a price discovery phase as price in the market seeks new value. And so that was the time when I wrote about it in the book, and it was I think the first example. And I said, wow, that was a 5-figure day, exactly 10 grand on that day, on that one trade, just because I was finally able to say, you know what, that one right there is what I've been looking for. I want to trade big out. Remember I told you I love to trade those big trending moves and grab the entire thing. So in order to do that, I had to study those markets that led up to it. So it's that developing pattern recognition. And so that's part of what I did. Part of identifying that inside value worked was because I would study what happened before that price discovery. I see. It was coiled like this, and we had an inside value. The narrow value right there implies expansion. All right, this is it. If we open up outside of that range, I'm getting in. And so we opened outside of range and outside of auction, outside of range up there, and then this took off. And I got in here, and I got out at the end of the day. And it was a huge move. Huge move. And so that was the ability and the power behind being able to forecast that. And that's why I said this was without a doubt my favorite pattern ever, at least up to that point. I don't know, kurtosis has a good edge right now, the K-trap, as it is. So this is, again, very easy analysis, but very powerful indeed. So last night, trading the USD and the JPY had an inside value, and you caught a good chunk of the move because of your training. That is awesome, SD trader. That is awesome. Great job. That's fantastic. I mean, when you just see these types of quick ideas, and then you notice it in the market, not every single one is going to turn out perfect. Not every one is going to turn out perfect. But you'll know the ones. You'll start to understand the characteristics that make for a better opportunity, and you'll be at least on guard that something's going to happen. And when you act, when you're able to read, react, and execute, man, that's what trading is. So fantastic job, ST. Fantastic job. So right here we have pivot trend analysis. So number one is forecasting. And forecasting with this one is basically this analysis allows you to predict the likelihood that a market will experience a trending price discovery phase, including providing directional bias by using value area relationships. So basically it's just looking at a string of value area relationships, and if they are significantly higher than, day over day or week over week or month over month, then the trend is bullish. If you have a string of lower value relationships in a row, then the market is considered bearish. That's pretty much it. So again, when you're looking at the value area day over day, and it's doing this right here day over day, it's printing at higher and higher value levels, that's confirming an uptrend. And so what we know in an uptrend is you want to defend counter trend rotations into pivot-based support levels or pivot-based confluence levels and look to fade it back in the direction of the existing trend. So forecasting using pivot trend analysis allows you to identify whether you're going to have a bullish or bearish trend. So not only are you able to forecast whether it's going to be a trending environment, but also direction as well, because value is giving you the tell. Now again, execution for this is just be a buyer during the dips of a higher value phase and be a seller of the rips during a lower value phase. Value relationships provides the ability to predict future price direction and behavior using value area pattern recognition. And this affords traders with great advantages, including the ability to plan your trades. So I just mentioned a little anecdote there where I was finally able to engage the market from a perspective where I went to sleep knowing that I was going to pull the trigger on an inside value breakout the next day. And I woke up knowing that I was going to pull the trigger on an inside value relationship that morning. And when it started to develop, I had already known what it was supposed to look like, how it was supposed to behave. So when I woke up that morning and the market opened, I triggered that entry and I held that trade and executed the trade management according to the plan that I set out the prior day. The previous day I set that plan out. Not just the previous night, but the previous day at the close of the market. The market closed. I said, this is the pattern. This is how I'm going to play it. I'm going to plan it out now. I went to sleep knowing how it was going to go. I woke up the next day knowing how it was going to go. If then statements. If the market does this, I execute. If it does not, I do not. The market did open in the way that allowed me to execute, and I did. And that is the major advantage to all of the various tools that we use for analysis, but especially with regards to pivot-based analysis, because the levels are so clear and the tools are so great that they offer these ability to watch these areas. So one of the great advantages, again, it helps you predict price direction. It helps you predict behavior, whether it's trending or trading range or quiet or volatile. It's scalable to all time frames. And I think this is very important right here. This analysis helps you ID a change of bias, And so when these relationships develop, an inside value relationship is a coiled relationship that implies a breakout, one way or another. An outside relationship implies a market that is range bound and more trading range bound, larger. Unchanged implies trading range bound but due for expansion, right? They each have certain guidelines. Higher value implies a bullish trending phase, so you should be looking to defend pullbacks. Overlapping higher value implies a lazy bullish trend, very choppy, lazy trend. And lower value is a bearish trend, and overlapping lower value is a lazy bearish trend. So each of these 7 relationships gives you a guidelines to help you identify what's about to happen or what could happen. They're guidelines. They're useful guidelines, right? But what's also great is that when the guideline doesn't work, it's a huge tell on a change of bias. It tells you that market sentiment is likely shifting and you're about to see a change of bias and trend. And so, for example, if you have a higher value relationship from here to here because prices were trending up and price, does this, it closes below, well, sorry, it wouldn't do that. It would probably do that. It closes below the upcoming value and then it opens below upcoming value. That's the market already rejecting the higher value stance that price is going to head higher. And it's since that rejection is happening, it likely implies lower prices. So that's something to keep in mind. RTH versus ETH, influence of overnight trading. That's a great question because the way I've answered it before was that I was strictly RTH pivots for the most part, at least at the beginning of my training with pivots. At the beginning when we were researching pivots, putting it on the data sets and doing all that and opening up ETH versus RTH, it was plainly clear that the overnight activity during ETH just was not up to par and wasn't really useful. But as the decade has kind of pushed on, and over the last 10, 12 years, we've seen much more participation in overnight trading. And so ETH has become a much more viable form of pivots. As a matter of fact, I use ETH pricing to calculate my weekly and monthly pivots. And I defer to the RTH for the day pivots. So I've been tending to use daytime RTH high, low, and close for the RTH time sessions. I've been using those to calculate the RTH day pivots. But when it comes to weekly pivots or monthly, I've been using ETH data, if that makes sense. So I like to use the RTH because I believe that an RTH close and an RTH open is very, very important price information. And so the RTH close is much more important in crude oil, the pit close, than it would be when the market kind of closes at 3 something, right? And I think that means a whole lot when it comes to a market and a settlement. So that's why when it comes to RTH, I will use RTH for day time frame pivots. But if I'm using weekly or monthly, then I'll defer to the ETH so I can get all the data. Is the change of bias more a trending day forecast or more a return of value type of day? So it's a change of trend typically. Change of bias is typically a change in trend, but on a day where it's attempting expansion and fails, then it would be a return to value. So typically speaking, when I talk about a change of bias, it's like a trending market, and we're going to see examples of this now. It's a trending market that looks like this, and all of a sudden it pops up here and starts to do that. Because typically speaking, the value area is here and here and here. Maybe it's up here right there, then maybe it's right there. And the next value area is here, and yet it closes above it here, and then it opens above it. So that is the change in bias that usually starts this. So usually I'm speaking in terms of trend, but there's other times when, say you're in a trading range market like this, and say price kind of went above the range here and printed higher value because it closed up here. Well, it may open down here now, and now it's rejecting that higher value relationship, and since it's falling back into the range, it's probably coming back to value within the range. So you can see both types of scenarios. So pivot-based analysis with regards to value relationships. So your ability to recognize the value-based pattern will allow you to forecast and anticipate future price direction and behavior ahead of the crowd and with accuracy. And that, again, is very, very useful. And so we just learned about the different types of value relationships, from wide value areas to narrow value areas, from lower value areas, and the ability to change bias. What I wanted to do was just mark a recent chart with some of these ideas on here. And again, it's not every single idea that will help you. It's knowing the ones that will be significant to determining the next major move of the market. And so this right here is crude oil, and this is the recent contract of crude oil. So this is actually probably today's trading. And again, I want to relate some of these concepts to the most recent market because you remember this impulse move right here, this key range? Remember that key range? That was a very important key range. We formed the low and snapped up 12 points, and then it came back to the midpoint and held right here. Well, then we failed to expand the range right here, and we had an inside value relationship. So when you fail to expand a range with an inside value, typically speaking, that opens up a move in the opposite direction. And that goes back to the research that I mentioned a long time ago that I did. Remember that research where I did a compression expansion research? So when you get expansion through the top of a range, so like this, and you fail, the move in the opposite direction is oftentimes 25% greater than otherwise would have been expected had it gone in the original direction. And that's kind of the same concept. Right here, this is a measured, hey, this is a coiling phase, inside value. This is a super narrow two months in a row after a phase of failed expansion. The expectation would be that you do see significant volatility and expansion ahead. So right here, I just want to relate this again to everyday charts. When you're looking at this and you see that this is crude and you form an impulse range and you're chopping in here and you're seeing the narrow value area, and I'm using the pivot range here. So this is the pivot range. So this is the pivot point, which is the high plus low plus close divided by 3. And the opposite end of the pivot range in a downtrending market is the midpoint. So it's the high plus low divided by 2. And then the difference between the midpoint and the pivot point, you take that differential and you put it across the opposite side of the range to create the entire pivot range. So this is the pivot range. So what we're looking at examples right now, we're looking at examples of pivot range examples where we're looking at basically the value relationship. So the way I look at the pivot range is I look at it as a value area or a type of value area. So you can use the actual market profile value area, You could use, the distance between H3 and L3 as a value area for the Camarilla pivots. There's different things and different ways to do it. And so this is one way of calculating a quote-unquote value area. So when things get very narrow, you're looking for expansion. When things get inside, you're looking for signs of expansion. When things start trending in one direction, you're looking to fade counter-trend rotations at pivot-based areas of confluence. Sometimes it's going to be perfect and it's going to bounce right off the pivot range and drop, pivot range and drop. Other times it won't be so perfect. It may come up and come a little bit and try to sit above it and then fail and then drop, right? Because we have that failed range expansion and those tendencies. This is the same concepts. And then right here, you also see this downtrending right here. So you should expect, once we get expansion and you get the move down, this pivot range forms lower than this pivot range. That's lower value. So right there, you know that, okay, as long as price remains below the pivot range, the expectation will be that price will continue trending lower until proven otherwise. And it does. Then it comes down here. Here's another pivot range and it's lower. So that gives you trend confirmation. It gives you directional bias, right? But then eventually that pattern will break. And so you have to understand the change of bias. So that's why I always say, I am always trading the current trend or the current pattern, or whatever the thing is, but I'm always looking for a sign of a change of bias. I'm always looking for signs that something's about to shift. Is the market sentiment about to change on me? Because you have to know ahead of time, otherwise that's when the stops come out and now you're heading out the same exit door as all the other folks, and that's when things get hairy in terms of trying to get out of trades at the same time, a major squeeze, bad fills, the whole nine, right? It's a big deal. How far will you project down at the October 15 area, knowing fail range expansion and inside value relationship? It's funny, when you get asked these questions, sometimes there's hypotheticals and then you answer the hypothetical, but in this case, it's fine. I should have just answered the question the way, because I'll tell you how we actually did it, which obviously you already know the answer to. The way I projected the target was just based off the key range. So I used the key range. And so that key range right here implied a move down, and we got that target. And so that's what I did to forecast that. So this was basically kind of, we knew that things were likely headed to the middle here and then back down. And then at the same time, this coiled up right here told us we could see expansion. So this was part of the additional color analysis that we needed in order to help us identify the expansion. But when it came time to identifying the targets, I used key range analysis in order to forecast that particular target. So with regards to the change of bias, let's talk about this for a second. So with a change of bias, here's what usually happens. This one's not a perfect example, but they never are. But what usually happens is you have a lower value relationship that forms, right? From here and down, right? From here and down. So this one forms from here and down to here. So the first thing I look for is if this relationship closed lower, if it closed lower here, or it's going to be lower, then price, actually this one is perfect, but it's not gapingly perfect, but price in the upcoming, or in the previous month, needs to be below the upcoming projected pivot range. So the pivot range is forecasted to be down here, but it closed the month above it. That's your first change in sentiment indication right there. And again, that's straight from the book. That's your first change of sentiment indication right there. So price closed the last day of February above the March projected pivot range. So how do you know that pivot range is there? Because we haven't traded March? Well, you just put in the high-low close of February, you put it into your equation, and it tells you where those levels are going to be. Right? Additionally, what confirms the shift in bias and the change of bias is when the next month opens also above the pivot range. So not only did the month close below it, but it also close above it, but it also opens above it. And that right there sparks the full-on short squeeze. So now when price comes back to the area where the squeeze initially occurred, that's where they defend and attempt to squeeze to the next level up. So now, for those of you who are in the Pivot Boss trading room, now you understand my analysis for why I believe that price in crude oil is going to 49s. Because that was the idea. I said this was the first time, and we just shifted. I said we pulled down to here, we're looking for 37, what was it, 35.17s, 37.15s, whatever it was. We got very close, didn't quite hit it, and then we bounced. And then back here I said I think we pulled back, and I think we're trying to squeeze. You know, you can see what I was looking at now. We've been trending down, but this is the first time we're starting to see a change of bias, and it's developing slowly. When it develops slowly, it can be even more powerful because there's more energy being built up in these waves here. You can see clearly where this market is starting to round off, right? And so now you can even see we do have a bit of a narrow value area here, a narrow pivot range, and that could suggest expansion as well. So there's a lot of different ways to use this type of analysis, and again, it's the ability to forecast those events that have highest probability odds of working out. So when the market is exhibiting these types of clean market structure, these types of principles have a higher odds of success. So this is pivot trend analysis. And this is pivot trend analysis with clean market structure. So this is pivot-based analysis and pivot trend analysis with regards to clean price structure. And again, remember the foundational market concepts. Price goes from accumulation to markup, right? Then goes into a distribution, then goes into a markdown, right? That's the typical 4 phases of the market. And so when we get into a markup phase, not all 2 markup phases are the same, right? Some markup phases have very clean price structure, and some are a little more volatile. This was one of those cases where it was very, very clean. Very clean. And so when we came down here, and remember this low, I'm not going to let you forget that low because we were all over it, right? 1800, we knew about that one. And price came into it and rejected, and price closed back above these little lows right here. We were talking about that right there. And look at the launch, right? Well, that low, once it launched, look how it broke through the series right here of overlapping lower and lower value relationships. So the market had been in a short-term downtrend, right? And then look at it though, because these are weekly pivots right here. So from week over week, it was lower, but look where it closed. It closed the week above the upcoming week's, the top of the upcoming week's pivot range. That's your clue number 1. Clue number 2, we opened above the current week's pivot range after a lower value relationship and after price closed above it. Those scenarios right there all point to a change of bias and a likely change in trend. And so if you go back to the videos during that time, I referenced the pivot range, I referenced that change. And I said if that's the case, the first pullback to the pivot range after a higher value relationship defends, or creates and develops, is to defend that level. So back then, all we were looking for was after this change in bias, and then the market successfully creates a higher value relationship, the idea is to defend a pullback to the pivot range, wherever it may be, for a look at a squeeze higher. And then the next week, you defend the pivot range for a squeeze higher, and you look to defend the pivot range for a squeeze higher, and you look to defend higher, right? And you keep on going until proven otherwise. And right now, we're up here somewhere. So that's what it looked like. That was the recent market. Markets do not always look this organized, though. But when the markets are this organized, obviously that's a great market to engage. And in this market, obviously in this portion, there was a lot of, hey, let's try the lows, trap them and go. Try the lows, trap them and go. So you have to know the games that go on at these pivots as well. It's not just, here's the pivot, so let's buy it and go. Sometimes it's that easy, but oftentimes it's watching to see who's getting trapped at those pivots and then running the stops should they fail. Because what this does is it keeps you disciplined to the trend. It keeps you disciplined to the trend. So if the market is higher value week over week over week, then all week long, you should be thinking, I need to buy weakness, buy weakness, buy weakness, buy weakness, buy weakness. So you execute your weekly plan based on buying weakness. You know, you don't know that this may be the low for the week, or this may be the low, or this may be the low, or this may be the low. But every time price got lower, you know, it kept bouncing. It kept bouncing because that's the support zone where the bulls are coming in and defending. So this is a powerful form of analysis because it keeps you not only disciplined to the trend, but it also helps you predict future price direction and behavior, and it helps you identify potential trade locations in the chart. So this is pivot-based analysis with regards to pivot trend analysis and volatile price structure. So I don't want to cherry pick and tell you that every single opportunity is beautiful and perfect, because it's important to be able to understand when to distinguish between a market that's basically auctioning with great clean price structure versus a market that's not so clean, instead demonstrating volatile, unstructured price movement. And in this case, we have a market that's clearly trending higher, and that's the expectation. You know, here's higher value from here up, higher value, higher value, higher value, higher value, higher value, right? Higher value day over day, and yet there's no clear, discernible price structure to this chart that you could trade. And if there's no clear, discernible price structure to trade a chart, it makes it very difficult to engage this particular chart and this particular market personality. So you have to know that punting is an option. It's okay to not trade a chart. It's okay not to engage a chart if it's not demonstrating the proper price-based principles that really allow for, you know, better trading environment, right? This right here, higher value the whole way, and yet it's all over the place, not clean at all. And so that makes it very difficult. But the goal, that this doesn't mean that this approach is now bad. It just means that the primary idea is to trade rotations to the upside. So the best idea is to look for the lowest lows, look for new lows, and look to fade new lows. That's it. Because they're trying to sucker people to get short, suckering them short. But this is a bullish trend. It's just a lazy bullish trend. So again, this just means that you can't use the pivots to find trade location. Instead, the pivots serve a utility in that they're telling you that this is a volatile price structure. The market's not adhering to these clean principles, so you either avoid it or change your tactic to trading new lows or fading new highs. That's the approach. All right, so right here, this is value relationships again. A couple of great value relationships in this chart. Again, the ability to identify these relationships, which are very, very easy. Higher value right here tells you that pullback should be defended, right? And see, there's different flavors of higher value, lower value, inside value. So you can see that this one was a big runaway market right here. And so price traded way up here. So it creates a very wide pivot range. And so on a very wide pivot range market here, the expectation would be for a trading range market. And so that comes in all flavors too. So that tells you that we're just not going to run off and take off. We're likely going to revert back to the mean. So that helps you understand that you could actually fade it back into the range, or you can wait for the range to be tested and then to look to reverse it back the other way as a new trading range develops. And so there's so many different ways again to use this. Here's another inside value. This is the inside value relationship where you have a super narrow pivot range here, and it forms inside the pivot range from the previous period of time. Now, a couple of things to notice. First, this one is super narrow, and also the preceding price structure is a coiled price structure. Additionally, you can also notice the placement of the inside value pivot range. Where is it in relation to the overall range of the engulfing range? And so in this case, it's in the lower half of the distribution. that tends to give you an indication that you're likely going to see a downside break. If it was in the upper distribution, it would tend to imply an upside break. That's not a foolproof guideline, but that's a guideline that you can use sometimes where you can say, hey, that's an inside value and it's also lower in the lower distribution, so I should be looking to perhaps ride a down move. And that at least gives you an early indication of what you should be or how you should be engaged in this market. Again, we have lower value relationships here and then here. But look at this. Don't be fooled, right? Where did price close the previous month on this one? Price closed right there on that red bar, and it was above the upcoming month's pivot range. And so that tells you right there that you're likely seeing a big-time shift in value. Now, obviously, in this example, we had already bounced a lot, but that didn't stop a lot of bears from coming in and defending at this level, because those are the ones that got squeezed, and then we saw the move up. So you can see again, bears defending the current rotation here. We're defending that pivot range. We got to move lower. It came back to the pivot range, so they defended again because we're in a downtrending market. But right there is where the stops came out. You can see that's the stops day, and that's the change of bias day. And since then, they came back and defended and squeezed up. And so you can see how that thing marked up. And after the first, so you have your first change of bias right here. So after the first change of bias move, and you get the higher value relationship that prints after that move, the first pullback into the pivot range is a high probability buying opportunity. And if we zoom out right here, you actually see that this happened a couple of times. So this is crude oil again, and you can see right here, this is the big range, right? You can see right there, this is where we had narrow value, and it led to a big time expansion here. And then over here, you can see it happened back here as well. It coiled up into this range, narrow value, and boom, look at that move right there. So this is crude oil. Remember, everybody was freaking out about how crude oil was selling off significantly and selling off, and nobody knew how low it was going, or nobody knew it was going to get to that low. We knew pretty early that this thing was clearly coiling up and had some really downside price levels to find, because then there was no price structure below 80. We knew it at the time in the trading room, even way back. So there's nothing below $80. So if it can't hold 80, there's nothing saying we can't just, drop so much lower. And that's what happened here. And you're able to then see and ahead of time that, you know what, prices are very coiled here. This is potential expansion likely coming, and you can see the expansion that occurs here and here. So pivot width analysis is very powerful because not only can it help you identify those compression phases, but after a phase of expansion, you usually get a phase of compression. So after you see a big time move in a direction, you should be expecting that the upcoming period of time is likely going to be bracketed. So you expect that by using the pivot range to identify whether it's wide or narrow. And so you can see, we had a run up right here, wide pivot range, trading range bracketed market, right? We had a big time move here, wide pivot range, trading range bracketed market. And so it's a revolving type of situation where you go from high range to expansion. You do this like that. So you get that compression leads to expansion. Then you get the compression leads to expansion. And these events right here are just little beacons of light that just say, hey, this market's ready to go. And when you know that, when you can step in front and understand, wow, that move, that's the type of move that could happen, then you want to be able to find that point in time and trade it. And so that's why I really like the pivot range, and I include it in the Pivot Boss pivots. It's included in the pivot, the standard floor pivots, and I also use it by itself. But you can also use the market profile levels very much in the same way, where you're using the market profile value area or even the volume profile value area. All right, so this is crude oil right now, and what I'm going to do is I'm going to add let's add study. Okay, user defined study. And let's start with the Camarilla pivots here. These pop up the daily right there. I'm going to do, let's bring up the monthly. All right, so this is the Camarilla pivots, and these are the monthly pivots, okay? And we talked about them being color-coded. We talked about the Camarilla pivots having a specific call to action, right? And you can see it right here. These are the monthly pivots, and pivots basically are calculated by taking a prior period of time and taking the high, low, or close, some data points from that prior period of time, and then using those data points to forecast the pivots for the upcoming period of time. In this case, the market is using the March data to calculate the pivots for the April timeframe, right? That's what's happening right now. In an uptrending market, the idea is to look to buy at the green pivots and hand it off at the red pivots. In a downtrending market, pivot-based analysis with regards to trend analysis, pivot trend analysis says sell at the red and drop it into the green. You know, sell at the red if you can get there, drop it into the green. That's the idea. So again, this is a specific call to action with Camarilla pivots. And so you can see right now, I only have 6 levels on these charts. Although we had, 10 levels on our spec sheet? It's because this one right here, the first red one is H3. So that one is H3. The second red one is H4. And this blue one is H5. Okay? This one right here is L3. That's the first green one. Second green one is L4. And this blue one is L5, okay? So the idea is that L3 is the highest probability odds reversal target. Not in a downtrending market, in an uptrending market. So in an uptrending market, it's the highest odds reversal buy point. And H3 is the highest odds reversal sell point. But there's a band of support. So these two right here create a band of support and resistance. So if price were to drop down to L4, then this still offers an opportunity to defend that pivot for a push into the H3, H4 target zone. Same thing for the top side. If price comes into H4, it's still an area to watch for a potential rotation back down. For example, right now, at least in this daily time frame, price closed above the H4 pivot here over the last 2 days. After seeing expansion, if price can't hold that H4, then these participants may get trapped. And if they become trapped, we may see a sell-off back down, right? So that's how you would use these pivots again, is to watch them just as we do any other pivots. So the Camarilla pivots, again, have color-coded call to actions. So when you see this change of trend here and price pushes up, the next month when price hits L3, that's where the majority of the market want to time an entry. And you see that market lifted off that area. And up here shows you the zone where the market has or should find resistance, and you see how it's come in there and found a little bit of resistance. So that's the general idea. Now, if the market were to push beyond this H4 and hold and find acceptance beyond H4, the expectation would be for price to continue higher into H5. So this H5 and L5 below it are considered expansion targets. These are expansion targets. So if you get outside the H4, R4 band, then you should be looking for expansion toward the L5 and H5 targets. So that's the idea behind Camarilla pivots. It's basically color-coded ideas here where once you see a trend develop, they provide really great areas to identify buy and sell opportunities. Additionally, you can see here, these things get coiled up as well. They get coiled up and you can see price push below H5, or L5 rather. Look at that. Price pushes right down through it, comes back, kisses it right there. Ed used to call this the kiss of death, and then boom, this thing would drop. Whenever price would drop through a pivot and then return to kiss that level from beneath, that was called the kiss of death. That was one of the first patterns that had a great name that I love to trade, and that's the type of move you can see. But it happened outside of the L5 band. So this is, again, You have to understand when to trade using these types of pivots. Using them in a trending manner is fantastic. Looking for signs of expansion. If you break outside the bands, look for the continuation targets. That's usually the way to approach it. For example, like right here, we're trending down, 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 right? And so whenever you break down below this pivot here, the implication would likely be for a continuation into L5 because we're in a downtrending market, right? So you're not expecting bulls to defend here in a downtrending market. You're expecting bears to defend here and run the stops. So in a downtrending market, you're more apt to be looking to defend and return price into L5. Here's the recent market with the ES. So down here, 1800, right? Big time level. At least with regards to February, price dropped down into L3 perfectly right there. So the low of the day on this day was L3. It rallied way up here. If you know that the monthly low right there is like 1865, call it, and it gets all the way back to 1920, I mean, you got nearly 60 handles here of movement off of one level. So when it goes back to the concept I mentioned before, bringing higher time frame levels into the lower time frame chart, this is something I'm talking about. Understanding that there is a monthly pivot sitting there, and then price drops into that monthly pivot, and that's where you see a liftoff. I mean, that's pretty amazing accuracy and precision there. But after it broke down below that level here, it dropped here, came very close here, and bounced back above. And ever since, it's been in an upward price discovery phase. But look at how price pushes through a pivot, comes back, and defends. Then pushes through a pivot, comes back, and defends. Right? I mean, sometimes it's uncanny how the market will react to some of these pivots. I mean, it's just it's impressive. Let's look at weekly for a moment. So here are the pivots on a weekly basis, and this is an intraday time frame. So I just put this on a 15-minute chart here, and this is the NQ with 15-minute charts on a weekly pivots. And this right here is the weekly L3. This is the weekly L4. So L4, L3. Look at that right there. This is the H3. That's the weekly H3. Look at the head and shoulder form there. The price went offered through the pivot there, and look, where did they defend? Right there at L3. I mean, isn't that uncanny? That's pretty fantastic. That pivot was so important on this week. And I haven't even looked at it. This is the first time I'm looking at it, so it's not like I'm cherry picking here. It's just sometimes the market really gravitates to certain sets of data points and pivots. And this is one of those types. I mean, it's fantastic. If we go to an hourly time frame, you can kind of see a little bit more. Let's look at what happened in the past here. So a few weeks ago, you can see price was basically bracketing here between L3 and H3. Then it traded the space up here and formed a box and failed to hold, and so it dropped back to L3. You see that? So you're supposed to buy in the green and return to the red. Right? Up here, you're supposed to defend and return to the green. Down here, you're supposed to defend and return up. Right? Look at this right here. Again, defend here, defend here. This down, this up. If you push through H4, then you should be looking for H5. If you hit H5, then sometimes you see this happen where they defend on H4, and then you step on it. So all the various rules that we talk about in the market, this is the same concept that we use here as well. You know, you push through a pivot and come back, you defend at that pivot if the initial impulse move took you to a specific price target, right? If it proves it went in that direction, then it should be defended. So a lot of these concepts continue to hold true. Again, look down here. Look right here, right? You start the week, you go up, it's sold off. Here's the bounce off of L3, it rallies. There's H5. So yesterday or last week, the high of the week was H5. So you can see that, again, there's a lot of great utility to these pivots, especially if you can understand what you're supposed to be looking at. Because again, I think it's one of the things that I always was asked, especially when I would do speaking engagements, how do you know to buy and sell there, right? How do you know to buy and sell that pivot? And early on, I used to just say you got to grin and bear it. You just got to put a limit and do it. Or you got to wait for the rejection with a wick reversal signal, and then you got to trade the retest entry, right? So that's when I said, you know what, when I write this book here, I want to make sure that when somebody is looking to engage these levels, they have at least a couple or a few forms of rejection to be able to play off those levels. That's why I created wick reversal signals, extreme reversal, doji reversal, and the outside reversal. Those are patterns that if you turn those on right now, you know, and start to identify those patterns at these levels, you know, it could be fantastic. So if we load some signals here and pop them up, if we load some signals like this and then bring those pivots up again, here we go. So let's remove these. And let's go to add Camarilla pivots again. There we go. So this is what this is the essence of the book, Secrets. This is the essence of the book, is that identify the pivots you want to trade. You have to know that if you want to be a day trader, you trade off the day pivots or the weekly pivots. If you want to be a swing trader, you trade off the weekly pivots and the monthly pivots. If you want to be a tinkerer and trade off of some user-defined set of pivots, then, you know, run the data and see which periodicity works in the current environment, right? It could be a tick chart, it could be an hourly bar chart, it could be, you know, hourly pivots. Who knows? But the idea is to identify those markets that are best and most conducive to identifying trending moves with the pivots. So it's easier to spot. Let's take a look. Let's switch gears here. And let's remove these. And let's bring up the floor pivots. There we go. This is the floor pivots. And these are beautiful. I love the floor pivots. These bring back fond memories. I really, really love them. And this is the way I originally coded them up, with the magenta value area. And the blue right here are the, you know, support and resistance levels. So it really stood out on my charts. And this is how I was first able to really connect some of these relationships. So you can see what I was thinking a long time ago, right? If I go to a daily time frame and let's pull up some monthly, for example. Okay, so here are the monthly pivots. Now, just visualize for a moment every single day having to hand draw your pivots. So you'd put the high-low close into a spreadsheet. You get the R1, you get R2, R3, R4. You get S1, S2, S3, S4. You get the pivot point, you get the pivot range high, the pivot range low. And now all of a sudden you have 11 lines on your chart, because you hand did it all. That was my preparation before the market opened every single morning, every day. And I'd have these lines that I would just put on there, and I'd have the weekly lines and the monthly lines on different charts. But I wasn't able to, I would trade it and see the utility, but I wasn't able to discern the pattern recognition right away. So when I said, listen, we got to get this coded, here's the specs and here's what I need. The first time I saw them on the chart, they looked like this, and I thought, it just felt like the angels were singing. You know, it was like, ah, right? Because I could see immediately the pivot trend. I could see immediately when there was, you know, portions here where you're seeing trading range with wide, right? When you're seeing, you know, coiled leading to expansion. When you're seeing a coiled market lead to expansion. You know, trending phases right here. Buy the dip, buy the dip, buy the dip. And that, I didn't even have to look at the support and resistance. I just had to look at the value area as represented by the pivot range, and I could see those things. And then that's where all the data-driven analysis came from, where I was then running these levels in various time frames, various products, and various derivatives of that data, and doing so many things. But the ones on support, the support levels are on bottom, right? And then the resistance levels are on top. So again, depending upon which way the market is trending, if you're trending up, typically speaking, when you're trending up, I always say, don't even look at everything below S1. So S1 is this first blue pivot. That's S2, S3, S4. 2, 3, 4. That's your pivot range. This is R1, 2, and 3 is up here somewhere. So if you're uptrending, ideally a very bullish trend should stay above the pivot range. A highly bullish trend stays above the bottom of the pivot range, and a lazy trend will stay above the S1 pivot. If it breaks below the S1 pivot for any amount of time, then it's not an uptrend anymore. So ideally, in an uptrending market, you're not focused on these pivots here. Instead, you're looking to defend here for rotations into the first and second pivots above. This would be R1, this is R2, right? That's typically what you're looking for. And then should you hold above R1, then you're looking to see further potential expansion into R3 and R4. You have to also know that R3 and R4 are not hit often. They're not reached that often. So you can see right here, look at the market. This is R4, R3, not even close. Here's R3, not even close, right? Obviously that's summer trading. But out here during the volatility, that's 1, 2, here's 3, and it got almost to 4, right? Over here it surpassed it. So there are points in here where it can get out there. But for the most part, you're concerned with S1 to R1 S1 to R2 for the most part, given the trend. If it's trending like this, remember, you rotate to perhaps S1 and you rotate into R2. You rotate into S1, you rotate up to R2. That's the idea. And reverse for shorts. The other idea is that when you see a significant market like this one, and you see this inside value relationship form, and you know that this is a distribution on highs, and you know that the market's having a tough time staying above the August high here, and you're thinking this distribution can lead to a retest of the August low, all of this starts to make sense where how you kind of just put all of the things together, and you piece those clues together, and when you have the puzzle pieces all set out, now you say, oh, this could be huge expansion. And instead, you're not focusing on buying or buying or buying or buying. You're focusing on those as targets. And so if you knew that this was an inside range, which we did at the time, we knew that there was a potential to see expansion. And now look how much distance you can get on this thing, and you nearly get the entire move if you're able to use every one of those, right? So when you have a tightly coiled range and you see expansion, you can expect a move toward the R3 and R4 bands. If you do not, and you see, volatility, then you're likely trading within the first band of support and resistance. So those are a few things to keep in mind with regards to the floor pivots. And each of these concepts, again, all of the pivots that we study, every single one lends itself to these types of rules. The rules based off of pivot-based analysis, scalability and volatility and trending-based analysis and width analysis. All of those forms of analysis just work. Well, that pretty much sums up pivot-based analysis for the core training portion of Pivot Boss Masters. And again, this is one of those subjects that's near and dear to my heart. I really, really enjoy this subject because, again, this is the subject matter that really made me feel that I was starting to do things in a professional manner. Because these tools taught me to not only forecast in the appropriate way, but also how to anticipate and plan for the types of trading environments that I was likely to encounter. And I think I try to pound that point as much as possible. Because when you're able to visualize a certain outcome, you're more likely to be able to achieve that outcome. So that's why I'm trying to train everybody. Hey, these are the tools. This is what we're looking for. But what we're looking for all stems from those foundational market concepts. Compression leads to expansion. Expansion leads to compression. Rejection to acceptance. Those types of concepts are our foundational concepts that the Pivot Boss method is just firmly rooted in. And so, when we're able to use the tools to find those scenarios, we can then engage the market like the proper knowledgeable market participants we're supposed to be. But with regards to pivot-based analysis, it's just a form of analysis that's so near and dear to my heart that I wrote an entire book about it. I wrote an entire book about it. That tells you how much I love this form of analysis. And again, I believe that this form of analysis has its place in every trader's toolkit, but the ability to blend the analysis into what you're doing is where you're really going to excel. Don't force anything that doesn't really complement what you're doing. Utilize those aspects that you find utility for, and then incorporate those into your trading. So again, I want to say thank you so much for being a part of this training, and I look forward to your thoughts on pivot-based analysis. Thank you, trade well, and I'll see you soon.